Hi, my name is Jason Watt, and welcome back to the Business Career College video series. In this particular video, we're going to look at dividends paid from a small business. And this video will work nicely with a few other videos. You might find the video on investment income useful here, especially the dividend portion. This is going to be part of a series of videos concerning shareholder compensation overall, and you might also find this useful as part of a series of videos concerning taxation within a corporation. So we're going to build a little corporation here, and then we're going to go through how it earns revenues and what those revenues mean when they're paid out to a shareholder. So, and as always, this is intended as general advice. If you need specific tax advice, as always, you'll deal with the appropriate professional. These videos are intended as general information only. So what we have here, let's just work with an operating company for now. And this operating company, again, we'll keep it easy, has a shareholder. We'll just give the company one shareholder. We'll say that Carla owns 100% of this company. And Carla's shares, not that it really matters for what we're going to work through here, but Carla's shares, we'll just give them an ACB at 0. So they were purchased from Carla, or they were acquired by Carla right at the start of when the company started. There was no value there. She did this all from scratch. And today what happens, she's a few years into this now, and the company has revenues. Now we're not going to work through a whole balance sheet and cash flow statement, but company has revenues, let's say, at $1,900,000. And the company has expenses. Now, for the time being, we won't include any salary that Carla might be pulling, but if Carla had salary, it would be an expense. So let's say, just for now, for the sake of ease, that this company has $1,200,000 of expenses. And what's going to happen then, and you wouldn't see it exactly like this on the company's statement of income and expenses, but we're going to look at what's taxable then. So this corporation would have $700,000 in taxable income. So all the expenses essentially create a tax deduction, and then we have taxable income here at $700,000. So with a small business, now this does vary a little bit from province to province, but with a small business, what then happens is we would take the first 500,000 of that, which is what most provinces do and what federal tax does, and then we take everything over 500,000. Sorry about that, just a little technical glitch there. So everything over 500,000, and that's going to be just 200,000. That's a pretty easy bit of math. And that first $500,000 of income is taxed at what's called the small business rate. So that's going to be, an 11% federal rate, and give or take around 4% provincial. It's sometimes a little higher, sometimes a little lower. It depends on the province that you're in. So let's call it a 15% rate. So 15% on $500,000 results in $75,000 of tax payable on that first $500,000 of income. And then on the amount over 500,000, so that's that $200,000, that's going to be taxed at a 15%, what we call corporate general rate federally. And then the provinces are going to match that as well. The provinces are going to have about a 10% rate. And again, it does vary from province to province. So let's call it 25% just for the sake of ease. And we would end up with $50,000 of tax payable there. So we can see in total then, that is $125,000 of tax to pay. Now, where does this take us? So we can see then that at the small business rate, that Carla's corporation here, OPCO, earned $500,000 that was taxed at that rate, but paid $75,000 in tax. So easy bit of math here, 500,000 of income, and sorry, 500,000 of earnings after tax, and $75,000 of taxes leaves us with $425,000. And then at what's called the corporate general rate, the corporation had more income, $200,000. And by the way, to have access to the small business rate, this would have to be a Canadian-controlled private corporation, and we're assuming that this is all active income. So all the $700,000 here, or all of the $1.9 million, we'll assume this is all active income. We will deal with passive income in a separate video. So we've got $200,000 here, and we paid $50,000 of tax down below, so we have $150,000 left at what's called the corporate general rate. And we sometimes refer to then the the general rate income pool. So you might see reference to the general rate income pool, or what most accountants will just abbreviate easily as GRIP then. We don't have a fancy abbreviation for the stuff in the 425,000 range. That would be, we would just refer to that as small business income, and that's just taxed at that small business rate. So what happens now is that Carla has essentially the ability to pay herself a $425,000 dividend from the small business pool, or a $150,000 dividend from the corporate general rate, or from the GRIP pool. So if she pays this from the small business pool, this was taxed at lower rates. We saw that was taxed at a rate of around 15%, again, depending on your province. So because it was already taxed at lower rates, if she pulls that out as a dividend, it's taxed in her hands as an ineligible dividend, or a non-eligible dividend. And that means it's going to be subject to less favorable taxation. Your tax consequences on this ineligible dividend would be an 18% gross up and an 11% federal credit. And we'll work through some math around this in a separate video. And then on the general rate side, if she decides to take that out in the form of a dividend, because that was taxed at higher rates, that was taxed at the 25% rate, so that was subject to higher tax rates. The trade-off there is that the taxpayer who takes that dividend now would see it eligible for eligible dividend treatment, which is a superior tax treatment in the hands of the taxpayer. And the way we're going to see this tax now is with, at least as of 2015, and by the way, the ineligible dividend rates are going to change too. The 2015 budget is introducing a progressive increase in the small business, a progressive decrease in the small business rate, which is also going to result in a decrease in the benefit of ineligible dividend taxation. If you paid less tax, we're going to give you less tax benefit there as well. So here we would have a 38% gross up, and we would have a 15% federal credit. So in the taxpayer's hands, the end result here is that the ineligible dividend you're going to pay more tax on, and the eligible dividend you're going to pay less tax on. But the corporation was in the opposite position. The corporation paid more tax at the corporate general rate than it did at the small business rate for each dollar of income. So when Carla makes the decision, or when, more accurately, the board of directors, which probably comprises of Carla, maybe a couple other people in this small business, when they make the decision to pay out a dividend, it's going to be either a small business dividend or a general rate dividend, and she has the ability to pay up to $425,000 of dividends from that small business pool, those ineligible dividends, and up to $150,000 from the corporate general rate pool. She can pick and choose. There's no saying she has to have one with priority over the other, and there actually is a fair bit of flexibility to determine how those dividends would be characterized. So I hope that helps to understand where small business dividends come from, or ineligible dividends, and where corporate general rate or eligible dividends come from relative to Carla's corporation. In a later video, we're going to work through the full tax consequences of each kind of dividend. I hope that's helpful, and I hope you enjoy your continued studies. Thank you very much.